Hello everyone, welcome back to Fundrise Finance. 2022 has been such a volatile stock market. Looking at this graph, we see the S&P 500 down more than 24% for the year. Just when everyone thought that the lows of the stock market were in the month of June, when we started to see a nice good rally of more than 17%. From there on, the market really tumbled all the way till end of September when we saw almost entire rally from end of June till mid of August wiped out. At the start of the month of October, we saw a wonderful rally of almost 6%, the best 2 days in the stock market since early pandemic in 2020. But after that, again, a big dip of almost 4%. So this is a classic example of extreme volatility in the market. This reflects even in the fear and greed index that CNN tracks. We are currently in the extreme fear category of 22. But should one get scared by what we see in the market, where every day there is a risk of seeing a new low? I personally feel no. A good disciplined investor should actually feel happy to see markets going down once in a while. Yes, I agree, such lows of the market will scare anybody, but a good disciplined investor who keeps on investing regularly into the market is actually getting more out of their investment. They can buy more shares of their favorite companies or ETFs in current market than they what originally do when the markets are up. Somebody buying here at the top of the recent rally in mid of August would have gotten less amount of shares for what they're investing compared to what they would have got by the end of September. That's why I really like the concept of dollar cost averaging, wherein at every paycheck, like how your 401k plan works out, it's a perfect example. No matter the market is up or low, your paycheck will get deducted by X amount and gets invested. So in such markets, it becomes more and more important to select your stocks very cleverly, buy those stocks which are undervalued, buy good stocks which can provide a good return in the long run. So in today's video, we will discuss 5 such stocks which I feel are pretty undervalued at the moment and give a good return for your money in the long run. Let's check it out. But before checking out the list for the month of October, let's see how our picks for the month of September have done. Here we had Citigroup, Comcast, JP Morgan, Medtronic, and Whirlpool. Among all of these, Medtronic returned the best, minus 5.38%, and then JP Morgan down almost 9%. For that, we see Whirlpool down just over 10%, then Citigroup almost down 13%, and Comcast just over 16% down for the month. With that said, let's see what my dividend picks are for the month of October. First on our list, we have Lowe's Companies, ticker symbol LOW. Lowe's is from the consumer discretionary sector and is a major home improvement retailer. Year to date, Lowe's has fallen almost 23%. In the last 1 year, down just over 5%. The last 5 years, though, it has returned an impressive 143%. It has a market cap of $122.4 billion and currently yields 2.13% at a forward PE of 14.61. From dividends perspective, Lowe's has been paying its dividends for the last 58 years, which makes it a dividend king, which means it's part of the S&P 500 and has been consistently raising its dividends and paying them for more than 50 years. The 5-year dividend growth rate is 18.77%. So a company which has been paying its dividend for so long and having its dividend growth rate almost, not even almost, it's more than twice that of the current inflation. This is really amazing. And the payout ratio is low, just over 27%. Lowe's has its ex-dividend date coming up on October 18th, so it's in less than 10 days from now. So anyone who owns the shares of Lowe's by this date would be paid $1.05 per share on November 2nd. Looking at the valuations, Morningstar considers Lowe's a 3-star stock with a fair value of $212. Value Line has a midpoint target of $234, while CFRA has a target price of $230. As for my own calculations, which considers current and historical yields, I found Lowe's to have a fair value of $245.33. Averaging all these four values, we get an average value of $230.33. That makes Lowe's undervalued by 16.8%. Second on the list, we have the Coca-Cola Company, ticker symbol KO. Coca-Cola is from the consumer staples sector and is involved in manufacturing, marketing, and distributing non-alcoholic beverages worldwide. Year to date, Coca-Cola has fallen almost 8%. Last 1 year, a return of over percent. Last 5 years, a return of almost 19%. It has a market cap of $235.74 billion and currently yields 3.23% at a forward PE of 22.17. From dividends perspective, Coca-Cola, just like Lowe's earlier, has been paying its dividends for the last 59 years, which again makes it a dividend king. The 5-year dividend growth rate is just over 3.5%. The payout ratio is a tad higher of just over 70%. From valuation standpoint, Coca-Cola is considered a three-star stock by Morningstar, which gives it a fair value of $58. Value Line has a midpoint price of $70, while CFRA has a target price of $72. As for my calculations, I found Coca-Cola to have a fair value of $56.85. Averaging these four values, we get an average price of $64.21. That makes Coca-Cola undervalued by 17.8%. The third stock on our list is Procter& Gamble, ticker symbol PG. Procter& Gamble is also from the consumer staple sector and provides consumer goods worldwide. If you look at the brands that Procter& Gamble owns, they cater to the length and breadth of our daily lives, right from baby care, where we see Pampers, we have fabric care that has Bounce and Tide. Then we have the Bounty paper towels, feminine products, hair care products like Head and Shoulders and Pantene, oral care products such as Crest and Oral-B, many of the skincare brands such as Gillette and Olay. So Procter& Gamble has a vast presence in the daily lives of its consumers. Year to date, we see Procter& Gamble falling almost 24%. In the last 1 year, almost 13% down. In the last 5 years, yeah, we see a positive return of almost 36%. Procter& Gamble has a market cap of $296.45 billion, currently yields 2.94%, with a forward PE of 21.13. From a dividends perspective, we again see here a massive streak of 65 years of dividend growth, which again makes Procter& Gamble a dividend king. The 5-year dividend growth rate is just over 5.5%, the payout ratio being just over 60%. From a valuation standpoint, Morningstar considers Procter& Gamble a three-star stock with a fair value of $126. Value Line has a midpoint target of $154, while CFRA has a target price of $168. As of my calculations, I have Procter& Gamble fair valued at $142.34. Averaging these four values, we get an average price of $147.59, which makes Procter& Gamble undervalued by 18.76%. The first stock on our list is Air Products and Chemicals, ticker symbol APD. Air Products and Chemicals is from the material sector that provides industrial gases to factories in different sectors. Year to date, we see Air Products falling more than 21%. In the last 1 year, a negative 12%. Last 5 years, though, we see a positive return of over 51%. It has a market cap of $51.4 billion and currently yields 2.8% at a forward PE of 22.51. From a dividends perspective, we see Air Products and Chemicals raising its dividend for the last 39 years, which makes it a dividend aristocrat, which is a company being part of the S&P 500 and raising its dividend for at least more than 25 years. The 5-year growth rate is impressive at 11.4%. That's more than the current inflation. It has a payout ratio of just over 62%. From valuations perspective, Morningstar considers Air Products a 4-star stock at a fair value of $321. Value Line has a midpoint price of $306, while CFRA has a price target of $316. As for my calculations, I have Air Products fair valued at $284.47. Averaging these four values, we get a final price of $306.87. That makes Air Products undervalued by 32.41%. The fifth and final stock on our list is BlackRock, ticker symbol BLK. BlackRock is from the finance sector that provides financial services to institutional and individual investors. It's in fact the world's largest asset manager with over $10 trillion in its portfolio. Year to date, we see BlackRock falling almost 40%. Last 1 year, almost 35% negative. Last 5 years, we see a positive return of over 18%. It has a market cap of $82.98 billion and currently yields 3.55% at a forward PE of 16.73. From a dividends perspective, we see BlackRock raising its dividends for the last 12 years. There's a very good 5-year growth rate of 13.9%, so well above the current inflation, and a good payout ratio of just over 47%. From valuations perspective, Morningstar considers BlackRock a 5-star stock with a fair value of $850. Value Line has a midpoint price of $810, while CFRA has a target price of $775. As for my calculations, I have BlackRock fair valued at $717.47. So averaging these four numbers, we get a final price of $788.12. That makes BlackRock undervalued by 43.19%. So to summarize, our dividend picks for the month of October are Airports and Chemicals, BlackRock Inc., Coca-Cola Company, Lowe's Companies, and Procter& Gamble. So what we have here is a good mix of consumer staple companies in Coca-Cola and Procter& Gamble, Lowe's in the consumer discretionary sector, Airport from the materials, and BlackRock from the finance. So as we just saw, all of these companies are fairly undervalued at this point, with BlackRock more than 40% undervalued and Air Products more than 30% undervalued. Coca-Cola and Procter& Gamble rarely go undervalued. So what we see now is a very good buying opportunity. And irrespective of what the market does, whether it goes up or down, as long as we are selecting good quality stocks and investing into them regularly, the investor always has an advantage. Current buying opportunities may not really last longer. The market at some point will pick up, and these stocks which are undervalued at this moment will give out the best results going forward. So hope you all like this video. I would really appreciate if you could hit the like and subscribe button so that YouTube can suggest this video to many more people out there. And until we meet in the next video, just try to do as much as possible to be financially healthy. See ya. Bye.